What Wall Street Trapper is really pointing out here is simple, but most people miss it. Holding cash feels safe, but in reality, it's being quietly drained by inflation, policy decision, and long term currency erosion. As we move into 2026, the gap widens even more between people who store value and people who let money sit still. This isn't about fear, it's about positioning. The system doesn't reward inactivity, it rewards ownership, assets, and strategic movement. If your money isn't working, it's slowly working against you. The real question isn't, is cash bad? It's, how long can you afford to stand still while the rules keep changing? Let's check out this clip.
Let me say this clearly. America's system is not designed to reward people who save cash. It is designed to reward the people who own assets. And in 2026, the gap is about to widen faster than most people even realize. Because if we're sitting on cash, waiting for the market to crash, this video will truly save you years of lost purchasing power. Because whether the market crashes or not, they will print money. And assets will respond, dollars will lose value, and it will cost more money for you to buy the same things. Also, in the end of this video, I'm gonna talk about two stocks that I am totally interested in buying before the year out to prepare me and us for 2026. And we family. So before you just invest in anything, I want you to do your due diligence, do your research, and last but not least, prepare to turn your last name to an asset. It's your boy, the Wall Street Trapper, man. Make sure you like, make sure you subscribe to this video because we definitely got a lot to talk about. Let's get to it, y'all. Now, most people think cash is safe. Now, we know that's a lie. It feels safe because the numbers don't move. But what if I told you that that's exactly why it's dangerous? Let's really look at reality here and not opinions. This year so far in 2025, silver is up 167%. Gold is up about 71%. The S&P 500 is up about 18%. The NASDAQ is up 21%. And the dollar is down 10%. It's worst year since 2017. Cash didn't crash. It just quietly lost the race. No alarms, no headlines, just less purchasing power every single year. Now, the system does not say this loudly, but it erodes silently. And you see it when you see the cost of goods going up, but what you're getting paid not going up. We see it when we look at the numbers saying everything is doing well in the system, but we looking at our checks and we looking at our bills like, wait, I still have more months left than money. Why does the system work this way? Well, here's what most people don't understand. The system is never designed for cash to be king. The system is designed for assets to reign supreme. Cash gets taxed first. Cash gets inflated away first. Cash gets punished the fastest. But assets do the opposite. Now, let's explain. Assets appreciate. Assets get favorable tax treatment. Assets compound. Assets are protected by policy. And what do the wealthy do? They take the money to buy the assets. And when things break, they don't save savers. They save asset prices. That's not politics. That's not theory. That's history. And so what we've realized, when we are coming from the survival mindset, we think we have to get cash, we have to get cash. But really and truly, the idea is to get cash to get the assets. And so the assets can move with the rules. Now, let's talk about something that kind of confuses people. Just bear with me in this video. Just bear with me. We were told that the economy grew by 4.3% in Q3. Well, why does that not feel like growth? Why is the consumer confidence still low? Why is healthcare so costly? Why is it that people feel like consumer sentiment is low, consumer confidence is low, job unemployment? Why do people not feel that expansion? It's clear. Prices are still high, credit card debt at all-time high, mortgages are under stress, auto loans are stressed, and people are checking prices day in and day out to see what they can afford. The growth isn't evenly distributed. As a matter of fact, If we dig back a little bit deep, we see that up to 40 to 90% of the recent growth in America right now is coming from AI infrastructure. Now, here's an uncomfortable truth. A lot of jobs that we know they're not coming back. A lot of majors that people majored in colleges, those jobs won't exist. Now, while AI will create jobs, it also will take away some jobs, a lot of jobs. And now we are positioned in what's called a K-shaped economy. Let me explain. And I'm gonna give you a visual on this. This is where the top half own assets and they benefit. The bottom half relies on the wages and they get squeezed. Nobody announces this. They just feel it. In case a lot of y'all don't understand what the K-shaped economy is, I want to show you this right quick so that you can see it, so that you can understand. So watch this. Right here on this map, I'm showing the wealth effect propping up America's K-shaped economy. It's something I talked about. I want you to see this because this is important for you to see and for you to understand. So watch this. In recent years, asset prices have increasingly moved beyond merely reflecting fundamentals. They have become key drivers and influencing fundamentals themselves. This phenomenon is clearly manifested in America's emerging K-shaped economy. In this latest Spotlight report, we'll explore what exactly constitutes such a K-shaped economy, identifying who is truly supporting the U.S. economy and examine the potential impacts of the stock market. Let's go a little further. The K-shaped economy, this term describes a macroeconomics, meaning big picture environment where different industries, companies, and social classes experience divergence, means two different things. Much like the letter K itself, with two distinct trajectories moving in opposite directions. One arm continuing upward, that's the people who own the assets. And then the other trends persistently downward, that's the people who sitting on cash. Watch this, let's go a little further. But simply, it represents a divergence between two phenomena. The classic example occurs during the post-pandemic recovery in 2021 when technology, cloud computing, software, and remote work enabled industries rapidly rebound. Watch this, the upper arm of the K. While travel, aviation, entertainment, and other frontline service industries struggle significantly, the lower part of the K. The fast forward to today and the K-shaped economy has reemerged. The stock market surges, tech industry professionals, high income groups, and white collar workers, those who has disposable income to invest, have seen dramatic increases in both market valuations and personal wealth, progressively widening the wealth gap and industry divergence. Simultaneously, listen to me here, y'all, low income groups, blue-collar workers, and frontline employees face displacement due to AI adoption, further reinforce the current K-shaped economy. The wealth effect has become more pronounced as the divide between high and low only expands. And if you look at this line, you see it. These are going up, this is coming down. So watch this. The S&P and the consumer sentiment, the S&P 500 and the people with wealth, they on the top part of the K. The people who not investing, the people in cash, they on the low part of the K. And this is just from 2020, y'all. Look at the line. And this is what I want us to understand. So let's go a little deeper. The wealth effect, it refers to this tendency for people to increase their consumption spending as their wealth grows, and conversely to reduce spending when declined. Simply put, when asset prices, stocks and real estate rise, asset holders, even before selling and realized gains, experience the increase in their paper wealth. This makes them feel wealthier and more financially secure, thereby boosting their propensity to consume and drive higher economic growth. How the wealth effect influences the U.S. Examining current U.S. household asset distribution reveals that higher income brackets hold a significantly greater proportion of their asset in stocks, funds, and other securities compared to middle and lower class groups. This creates a dynamic where rising stock markets leads to increased consumption among high income households. Here's what I just want you to understand, my family. The K-shaped recovery simply says, those who own assets will consistently increase their wealth. Those who are sitting in cash will consistently decrease in wealth. And you will feel poorer and poorer each day. And this is about design. And the reason why this is about design is because we have a president in Donald Trump who's coming in office saying, 2026, the economy is going to boom. Well, who will it boom for? Who will it boom for? Remember when Jay Powell got on the stand, he said, the economy is getting better, it's getting stronger, but we feeling pressure in the lower middle class, working class pocket of America. Well, that's the majority. The majority of Americans are that lower income pocket. So how is it that America is doing better? I'll tell you why. Because we are not looked at as equal if we're not a part of that 1%. And this is how we get there. We get there by learning that the more that they print money, the more that your cash will lose value. We see that the more that the dollar goes down. This is the debasement trade that we talked about a while back. This is why we see gold and silver going up. Yes, it did go down today, of course, but guess what, y'all? That's simple profit taking. That's part of the game. So here's why I want you to understand. If you're waiting on a crash, that's dangerous, because every cycle people say the same thing. I'm waiting for a crash. Well, I want to ask you a question. And just pay attention. I want you to hear me well when I ask you this question. Again, how long did it take us to recover from COVID? How long did it take for us to recover from the April lows? How long did it take for us to recover from 2022? It happened fast. Quick as in any time span. You know why? Because before they just let this thing bottom out, they'll print money. And that's the answer. Liquidity, stimulus, rate cuts, asset reignition. Crashes don't destroy the system anymore, y'all. It gets compressed. And the people who only counting on cash is the people who feel it. Because right now, printing money is part of survival. And that's why I say this, and I say this calmly. If we are holding on to cash, we are setting ourselves up for financial suicide. Because we see the dollar is falling. And remember, Scott Bessent said, 2025, we were setting it up. 2026, we're going to feast. We are not the we he's talking about. When they talk about the gold standard of America and manufacturing coming back and all that, yes, but we're not getting those jobs. AI is. Why do you think they keep having meetings with the 1% and the people that own these huge companies? It's so they can put robots in place. And I'm not here to paint scarcity to you, because I don't want you to get scared. I don't want you to feel like that. I want you to be proactive in what it takes for us to succeed in this world, and it's owning assets. There's no way around it. So stop getting caught up with the people saying the market gonna crash. You embrace that. So let's get into these two companies that I like moving forward. Going into 2026, because I think that for a fact that the debasement trade is in play, which means the dollar is going to keep losing value and precious metals will keep going to do their thing. Let's talk about Newmont, because most people misunderstand gold stocks. They think gold is about fear, and it's not. Gold is not about fear. Gold is about trust, or the lack thereof, the lack of trust in the American dollar. So what Newmont actually does, ticker symbol NEM. I want to put it to us simple and plain so we don't get lost. Newmont is the largest gold mining company in the world. They don't just speculate, y'all. They don't just trade hype. They pull gold out of the ground, refine it, and sell it globally. That's right. They pull it out the ground, refine it, sell it globally. So when central banks buy gold, when currencies weaken, and when money gets printed, Newmont benefits from it. And we see companies like China, and we see companies like Russia stacking up more and more and more gold. We see the precious metals becoming a play. So why gold matters now? Well, not the usual reason. Most people think that gold rises just because a crash is on the way. And that's not the real driver here, y'all. The real driver when it comes to gold is gold rises when confidence in money declines. So it's not about crashes itself. It's about when the confidence in the money declines. More money is printed. The same amount of goods need more money. Currency buys less. Gold holds more value. Gold doesn't explode overnight. It literally just outlasts. And it will definitely outlast the money that you have sitting in a bank. Now, when I think about Newmont, I also want to talk about some of the advantages that it has. And here's why Newmont isn't just another gold stock for us to look at. It's one of them ones. It's one of them prestigious ones. It is in a league of its own. It has a global footprint. It has lifelong reserves. It scales lower cost per ounce and an ability to survive downturn that really smaller miners can't. When weaker miners struggle, Newmont consolidates its power. And that's the important part to this game. It's not just about buying gold. It's about saying, hey, I see what's happening here. I see what Trump is doing. I see they're debasing the dollar. I see that so they can get asset prices up. Cool. But who benefits from that? Newmont carries real assets, not just promise. They have strong operational cash flow. They have a dividend paying that's solid. They don't have a lot of leverage, and they benefit directly from higher gold prices. This is not a moonshot. This is not a to the moon. This is a portfolio insurance on your dollar. So NEM, we like that going into 2026. And let me say this before we go further into that. When the markets wobble, Newmont doesn't need excitement. It just needs to be present. And when I say present in your portfolio. That's why it belongs in the 2026 conversation. Next on my list is Lam Research, ticker symbol LRCX. Now, let's talk about the other side of the system. You talk about Newmont as being insurance. Well, Lam Research becomes the infrastructure play. That's right. It becomes the infrastructure play. What Lam Research really does, and without being complicated, they build the machines that make the advanced chips possible. So we think about AI and the machines that's being made. The chips don't make themselves. Well, they make the machines that make the chips possible. They don't make the chips. They make the tools that shape them. Every advanced semiconductor goes through Lam Research's equipment at some point. I'm going to say that again. If a nickel bag gets sold in a park, it can't get sold in a park without Lam Research examining it. And that's why they matter. Because AI isn't just software, y'all. Nope, it's not just software. It's deeper. AI is physical. That's right, it is physical. Not only is it physical, but it requires more chips, smaller chips, more layers, and more precision. Now, one of the things I like about them too, they have pricing power. That's one of my favorite things about a company, right? And here's what separates them, right? They don't beg for customers. Their customers actually depend on them. They have higher switching costs, long-term service contracts, and deep integration into fab. That's the thing. These are the things that's necessary for chips to get made. So when chip spending is low, Lam doesn't they don't like disappear. They still getting consistent money. And that's the type of companies I like. Companies can't break away from with ease. Companies need no matter what. It's kind of like, our AC. We need it no matter what. And we need the water no matter what. And this is where long-term investors lean in. The financial strength, strong cash positions, high margins, discipline when it comes to allocation, and really good, strong shareholder returns. They're not over-leveraged. They just prepare. And that's true to when it comes to us investing in companies to 2026. A lot of people get caught up in the hype and what's on the radar. Me, I like to look under the radar. People chase chip designers, but they ignore the chip enablers. But every chip that enables quietly compounds. That is truly how real wealth is built. Here's a strategy that most people gonna miss every single time. And here's how we connect it for you so you can really get it and understand. The system is expanding. Money is flowing. Rates are pressuring lower. No problem with that. But not every asset benefits the same. And we need to know that. We need to understand that. So you want one asset that has purchasing power, and you want another asset that compounds innovation. And that's what we get with Newmont and Lam Research. That's not fear, y'all. No. That's balance. And I think that's how we got to go into 2026. We go into 2026 with balance. We're not chasing all the hype. We're going out with balance. Remember, this is a midterm election year. There's going to be turbulence here. But after the turbulence, the stock market got some of the best returns after a midterm election year. And I'm going to leave you with this. Cash waits while assets never stop working. And in a system built on expansion, waiting costs more than being active. 2026 is about being perfect. Nope, it's not about being perfect at all. It's about being in position, family. And my question to you is, are you in position? Because when money moves, it doesn't ask for permission. Nope, it don't ask for permission. It just does what's necessary. And if this video made some things clear for you, man, listen, you're already on edge. You already have what it takes to be successful in this game. So I want to make sure you like, make sure you subscribe, make sure you share this video out, man. It's your boy, the Wall Street Traveler. Salute. I see y'all in the trap.